The only people who are really long of gold, and I think we ought to note this, really are the central banks. They've been accumulating gold, and we need to ask ourselves why. And I suspect also that quite a number of countries around the world have been putting gold quietly into their sovereign wealth funds. The situation going into 2024 looks to be, I think, about as positive as you can really get. I think things are going against the dollar, and that is the most important point to understand. And if people can really grasp that, rather than thinking that gold is rising, then they're halfway to understand what the future is for the dollar, and therefore how that is reflected in the dollar price of gold.
Gold prices surged significantly in 2023, surpassing the $2,000 mark, propelled by a correction in the dollar and US Treasury yields. This adjustment occurred following the US Federal Reserve's decision to pause its rate hike campaign and indicate potential rate cuts in 2024. Recent market changes tied to the last FOMC meeting suggest a perceived policy shift, with the dollar's index falling and US Treasury yields dropping. Alasdair Macleod, head of research at Gold Money, is bullish on gold in 2024, citing its breakout from a prolonged sideways trend as a strong indicator. He emphasizes seeing beyond gold's rise, stressing broader implications for the dollar and how it influences the price of gold. The US dollar is poised for its worst year since the onset of the pandemic, as Wall Street bets the Federal Reserve is set to lower interest rates after safely reining in prices. Meanwhile, he is surprised by gold's resilience versus silver at year-end, noting silver's decline in a tight market. He speculates that bullion banks might have profited from silver. However, Macleod hints at central banks accumulating gold, while some countries may quietly add it to funds or undisclosed accounts. There was a 100% increase in gold accumulation by the world's central banks in 2022, and the trend continued in 2023. Central banks bought over 800 tons of gold in 2022, compared to just 450 tons in 2021, a near 100% increase. He emphasizes gold as money, not credit, citing its limited understanding due to US Treasury influence. The WGC data suggests that Singapore, Turkey, China, India and Russia are the top states buying the most significant amount of gold at the start of 2023. Now we present the clips of Alasdair Macleod's insights from his recent interview with Liberty and Finance. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
I was very surprised that the price of gold held up so well right into the year end. Silver was less so. That was interesting because that is a very tight market, and they did manage to move that one down, so much so that actually on the year silver was unchanged, which from the point of view of year-end valuations would have been extremely profitable for the dealers in the bullion banks. So perhaps that's where they made their money rather than in gold. Now, having said that, the outlook for gold, I mean, there's no doubt about it. If you look at the technical analysis, the chart looks absolutely wonderful. I mean, it really does. You've got, you're breaking out of a, two and a half year sideways move, because I think it first hit the $2,000 level back in August 2020. We've finally broken through that convincingly. Underneath this, the moving averages are in bullish sequence. I mean, the whole thing, really, it's absolute technical, textbook bull market, which is great. And the other thing that's so surprising in this is that apart from perennial gold bugs who are always bullish, I mean, let's face it, when things go down, they complain like fury that it shouldn't have gone down. But apart from those very, very few vociferous people, nobody is really long of gold. I mean, it is extraordinary. The only people who are really long of gold, and I think we ought to note this, really are the central banks. They've been accumulating gold, and we need to ask ourselves why. And I suspect also that quite a number of countries around the world have been putting gold quietly into their sovereign wealth funds or into various accounts, which are just basically not visible to the rest of us. So the situation going into 2024 looks to be, I think, about as positive as you can really get. Now, I wrote about this in my article for Gold Money last week. That was the last week of 2023. And I was trying to make the point, and I think this is a theme going forward. I was trying to make the point that it's not gold going up, it's the dollar going down, or other paper currencies going down. And indeed, if you look at the gold price in sterling, we're not at the highs yet. But that's because sterling has been rallying as the dollar has gone down, if you like, on a trade-weighted basis. I think it's terribly important to understand that the purchasing or the value of gold and its purchasing power generally varies very, very little over considerable periods of time. And any variation in value in the short term is probably as a consequence of shifts in the valuation for the paper currencies in which it's measured. And not only that, but of course, we have a situation where after 52 years of propaganda from the US Treasury, very few people actually understand that gold is money and the rest is credit. And that, I think, is a very important message for everybody to understand going into 2024. So it's not a question so much of gold going up, but the dollar going down. And we can see that on the trade-weighted index, the dollar has started falling actually quite rapidly. I mean, I think in the last couple of months, it's gone down from 107 to around about 101.5. It's rallied just a little bit in the last few days. That has been accompanied, accompanied by a decline in the yield on the US Treasury bonds going out along the yield curve. The 10-year has declined from 5% to, at one point, down to below 3.8%. That's a very significant move downwards. And what triggered this, of course, was the last FOMC meeting and Jay Powell's prepared statement, which led everybody to think that there had been a pivot in policy.
Alasdair Macleod foresees stable gold prices due to weakening paper currencies, distinct from the fluctuating dollar. The value of gold anticipates the decline in paper currencies' purchasing power. Gold is also well known as a smart hedge against inflation, allowing you to preserve wealth while paper currency loses its purchasing power. Furthermore, Macleod distinguishes between tangible assets and credit, noting that credit, including bank deposits, bonds and equities, will encounter challenges. ABA's Economic Advisory Committee, composed of chief economists from North America's largest banks, expects credit conditions to worsen in the coming months. He is concerned about high bank leverage, expecting increased worries as the economy possibly heads into a recession. Let's get back to the interview.
I think that the best way to tie in the value of gold in terms of commodities, products, whatever, is to think in terms of those basic raw materials. Because there is obviously considerable variation in the manufactured outcome of the combination of these raw materials. But taking that into account, I would expect to see, as the purchasing power of paper currencies falls, obviously, the cost of consumer items will tend to rise accordingly, and there will be considerably greater stability in their prices measured in gold than in the paper currencies. So that, I think, is certain to happen. The answer to your question is yes, there will be, if you like, a far more consistent pricing in gold than you will see in a collapsing value of the dollar. I suspect that as the situation develops, gold will begin to, in terms of its value, it will begin to anticipate increasingly the decline in the purchasing power of paper currencies. In other words, it will be ahead of the price effect, if you like, in the supermarkets and, on the forecourts and all the rest of it. But I think we need to draw a very, very clear distinction. You mentioned the word credit. When it comes to anything which is credit, in other words, something that you don't possess, but expect to possess in the future, contractually or any otherwise, it's that credit which is going to be the real problem. So the really nasty consequences are going to be against credit, and credit includes not only bank deposits, not only bonds, which basically are a promise to pay interest plus the principal at the end of a period, and not even equities, because equities are actually credit. What happens is that you part with, call it money or credit if you like, some means of a company being able to pay its bills in return for a slug of the equity. What is the equity? The equity effectively is a perpetual promise to pay you the share of the profits, your share of the profits in the company. So all these things are credit. Credit is the way in which the whole world actually revolves. I think that looking into the coming months, however, the situation, I think, is going to become worrying again. I mean, you're right in saying that these banks are very highly leveraged. I mean, to give you an example, the risk-based capital ratio of FDIC insured banks at the moment is around about 14 times, 15 times, something like that. This is not as bad as elsewhere, I hasten to add. But look at it this way. If you've got, if a bank's got a balance sheet, let's say, of $1 trillion, and it's got losses of 10% of that, then it's going to wipe out its equity. That's the reality of the situation. Now, as we go into a recession, people are going to start worrying about this. Now, at the moment, the statistics say, well, what recession? I mean, okay, things have slowed down, but there's no recession. But there is a mismatch between the GDP number, which is basically the amount of credit in the economy, and the purchasing power of that credit. What tends to happen is that the expansion of the credit happens first, probably 18 months ahead of the effect on the price level because of the Cantillon effect and so on and so forth. So, saying that GDP's, real GDP is fine, it's looking all right, we're not in a recession. I mean, this is complete rubbish. It just ignores the time lag, if you like, between the expansion of credit and the effect on prices.
The outlook for gold appears promising, driven by a combination of factors. Gold entered 2024 under pressure from a jump in the US dollar, but held its ground on expectations the Federal Reserve would cut interest rates this year, and rising concerns over attacks on shipping in the Red Sea. How do you view gold's role in your investment strategy following potential economic challenges and currency fluctuations? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.